Welcome to Left Africa.
You know, if you've been reading the tech headlines lately, you have probably seen this just staggering number flashing everywhere.
Yeah, the 1.5 billion.
Exactly. $1.5 billion. That is the amount of disclosed venture funding that African startups just pulled in the first half of the year alone.
It's a huge number.
It really is. I mean, it sounds like an absolute economic miracle, right?
Yeah.
Like an entire continent leapfrogging the industrial age and just sprinting straight into a digital golden era.
On paper, yeah, that's exactly how it reads.
Right. But okay, let's unpack this, because today, for our deep dive, we have a really fascinating stack of fresh sources.
We do. We're pulling deep data from Africa, The Big Deal, Partech Africa, and PitchBook.
Yeah, and our mission today is to look past that glossy PR narrative of the $1.5 billion and answer one really critical question. Who actually benefits from this cash?
Right. And to do that, you have to look at the macro context, because honestly, that's the only way to make sense of a number that large.
Totally. So where does that put the region globally?
Well, that 1.5 billion puts sub-Saharan Africa basically neck and neck with the Minane region, you know, the Middle East and North Africa.
Oh, wow.
Yeah, Minane logged about 1.57 billion in that exact same window. So what we are watching is global dry powder just aggressively chasing emerging market tech.
Right. There's just so much venture capital looking for a home.
Exactly. But, and this is the core contradiction of our deep dive today, what the data reveals is this massive, jarring influx of wealth happening against a backdrop of very real, everyday economic pain for the average citizen.
Yes. And that tension right there is exactly where we need to start, because when you zoom in on what specifically is absorbing all this dry powder right now in 2026, it is entirely dominated by the AI gold rush.
Completely dominated.
I mean, our sources point to this company down in South Africa named Hyperdef.
Right, the software platform.
Yeah, they just raised a $1 million seed round for an AI-powered software development platform. And it is just the perfect symbol of these small-scale, super high-hype AI bets.
It really is the quintessential 2026 deal.
Yeah. And on top of that, we are seeing Western tech giants and massive foundations pouring AI research grants into prestigious universities.
Places like the University of Cape Town, Strathmore, and Ames, right? The African Institute for Mathematical Sciences.
Exactly. And they are heavily funding model training, data sets, compute access, all of that. But while this academic prestige and all this funding sounds amazing, there is a wild cultural signal from the sources that just stop me in my tracks.
The Google Trends data.
Yes. In mid-July 2026, the Kenya Revenue Authority, the KRA, was trending at 200 plus on Google Trends.
Which is wild.
It's crazy. It's like reading about a massive lottery winner in your town, but you and all your neighbors are suddenly getting audited.
That is a great way to put it.
There's this palpable friction between the VC euphoria and the state's fiscal squeeze on everyday people.
What's fascinating here is that the causality of that friction actually starts with those university grants.
Wait, really? How so?
Well, on paper, the grants look beautiful, right? Academic prestige, localized research. But they primarily fund cloud compute credits on Western servers.
Ah, I see.
Yeah, the research feeds back into Western journals and foundational models. It generates tremendous PR for the tech giants, but it rarely translates into large-scale local employment.
Right. You aren't building a factory that employs 10,000 people.
Exactly. You're funding a lab of like 12 brilliant postdocs, and their outputs ultimately optimize models owned by companies in Seattle or Silicon Valley.
Wow. So if the local street isn't getting mass employment from these AI labs, where's the money actually going? Because clearly it is not sitting in local bank accounts.
Right. And if we look at the sectoral breakdown, it tells us exactly what kind of infrastructure venture capital is actually willing to build.
Right. So let's break that down. Fintech is still king, right?
Completely dominates. Fintech makes up about 45% of the total deal value. We're talking payments, buy now, pay later, crypto.
Right. And AI and machine learning are the fastest growing, sitting at about 25%.
Yeah. But then look at the physical foundational sectors. Clean tech and climate tech like solar mini-grids and carbon credits, they only get about 12%.
Which is crazy considering the energy needs.
Totally. And health tech and ed tech combined are chronically underfunded at just 10%.
Right. Because venture capital just heavily favors software layers that can basically bypass physical reality.
Exactly. You don't need to pave a road to launch a crypto wallet.
Right. You just need a cell signal.
Exactly.
And, you know, it's not just the sectors that are narrowly defined. It's the founders receiving these giant checks. The data shows an incredibly tight demographic profile.
It really does. It skews heavily toward English-speaking, globally networked founders.
Right. They are very often alumni of elite Western accelerators,
Yeah.
like Y Combinator or Techstars.
Hooked into those wealthy diaspora angel networks.
Exactly. Meanwhile, women-founded startups are sitting at a marginal 12 to 15% of the funding, which is just abysmal.
It's very low, yeah.
But, okay, the detail from the sources that completely rewired my understanding of this entire ecosystem is the dual headquarters structure.
Ah, yes. The dual HQ illusion.
Yes. The sources note that the vast majority of this AI and machine learning equity goes to startups functioning with dual headquarters. So they maintain a physical office in, like, Nairobi or Accra.
Right, where the engineers are.
Yeah. But they are paired with a legal and financial headquarters in London or Delaware or San Francisco.
Right, because that is a non-negotiable requirement for almost every major venture fund.
Wait, really? Non-negotiable?
Pretty much, yeah. Investors want their money deployed in a jurisdiction they trust, governed by corporate laws they already understand.
Okay, wait. If the intellectual property and the tax base sit in an offshore holding company, isn't this just a Western company with a remote, cheaper African engineering team?
Structurally, yes. You're describing exactly how it functions.
I just struggle to see how this gets categorized as an African startup if the entire legal and financial architecture is American or British.
Well, we can validate that exact point by looking at the exit data.
Okay, let's look at the exits.
Because the ultimate goal of the venture model is the liquidity event, right? The exit. When a company is acquired and everyone cashes out.
Right.
In the first half of 2026, there were between $350 and $400 million in disclosed exits in sub-Saharan Africa.
Which sounds like massive local wealth creation.
On the surface, yes. But the mechanics of a venture capital term, sheet-specifically liquidation preferences, dictate a very different reality.
Okay, let's get into the mechanics of that. Because liquidation preference sounds like super dry finance jargon, but it completely dictates who actually gets rich here.
It is the single most important clause in the contract. A liquidation preference basically guarantees that the international venture capitalists get their initial investment money back first.
Right, usually with a guaranteed multiple.
Exactly, before anyone else sees a single cent.
So, if an Accra-based startup is sold for $40 million, but they had raised $30 million in venture funding,
then the investors use their liquidation preference to take their $30 million right off the top.
Wow.
And whatever is left over is distributed among the common stock.
Which means the local African developers, the people who actually wrote the code, built the product, and took the risk on a low startup salary, they are left splitting crumbs, if there's anything left at all.
Exactly that. And, it actually goes further.
How so?
Think about what happens to the local government during that $40 million acquisition.
Oh, right. The taxes.
Yeah, they see almost zero tax revenue.
Because of the dual HQ structure.
Exactly. The actual transaction took place between two holding companies in Delaware. No physical assets were sold in Ghana. Shares of an American C corporation changed hands.
Wow. So the grand liquidity event that gets celebrated in the press is, in reality, just liquidity for a venture fund in London or San Francisco.
Not the developer in Accra.
That is wild. So if the exits are happening offshore and the IP is held offshore, what about the original promise? Because for the last decade, we were told venture capital would create millions of local jobs, bank the unbanked, all of that.
Right. But the macroeconomic math in our sources tells a completely different story.
Let's break down that brutal math.
Sure. Let's zoom out. Sub-Saharan Africa's GDP is roughly $2 trillion.
Okay, $2 trillion.
Right. That $1.5 billion in startup funding, as massive as it looks in a headline, represents a microscopic 4.075% of the GDP.
Less than 0.1%.
Exactly. And furthermore, 80 to 90% of all employment on the continent is in the informal economy.
Right. The street vendors, smallholder farmers, local markets.
And zero venture capital dollars reach them because informal economies just don't fit into venture scale software models.
Right. And against a youth population of roughly 450 million people with youth unemployment between 20 and 45%, the gap is just staggering.
Yeah. The formal economy needs to absorb about 10 to 12 million new entrants every single year.
Wow. And how many does the tech ecosystem actually employ?
Continent-wide. Maybe 100,000 to 150,000 people total.
Here's where it gets really interesting. The VC model inherently optimizes for minimizing headcount. right?
Yeah.
Like, that's the whole point of software.
Exactly. It's a feature, not a bug.
Right. You build a SaaS platform once, and you scale it to 1 million users without hiring proportionally. So a heavily funded startup might create, 30 to 80 jobs over 3 years?
Exactly. Which fills less than 0.5% of that 12 million job gap.
Right. So the classic tech leapfrog narrative is starting to look less like a leapfrog and more like building a digital penthouse suite on an economy with no industrial foundation. I mean, startups don't build factories.
They don't, and they don't lay power lines. They just build software layers on top of whatever infrastructure already exists.
Which forces us to look at the actual profit mechanisms of these software layers.
Right, take fintech. The promise was always poverty alleviation. But if you look at the VC-backed unicorns, the profit is in extracting high merchant fees and capitalizing on foreign exchange remittances.
They're just skimming margins off the movement of money.
Exactly. And AI startups, they train on Western cloud infrastructure, use Western models, and pay their bills in US dollars. The value accrues to global platforms, not local populations.
Okay, so if we combine that severe lack of broad job creation with the offshore hoarding of wealth, you naturally get a political boiling point.
Which is happening in real time in 2026.
Right, because the formal economy is thin and the venture wealth is legally shielded. Governments are desperate for revenue to service their debts.
Right. So they tax harder.
Yeah, the sources talk about E-times and aggressive VAT automation.
Yeah. And when you deploy that in an environment where inflation and severe currency depreciation are already devastating purchasing power in places like Nigeria, Egypt, Ghana, Ethiopia, Kenya.
The everyday citizen feels like they're being actively punished just for trying to run a business.
Exactly. And the currency mechanics really explain the resentment here.
Right, because if a dual HQ startup raises a $100,000 seed round in USD, that money goes incredibly far locally.
Yeah, they are essentially arbitrating the collapse of the local currency.
Wow. So the founders and the foreign shareholders win while locals lose purchasing power.
Right. The startup's financial runway actually extends as the local currency weakens, which creates an insulated elite class earning USD.
Detached from the local economic reality.
Entirely.
And what happens to the successful local engineers and founders? The data points to a massive brain drain, right?
Yeah, they are accelerating the relocation to the Gulf like Dubai and Riyadh, or to the west.
So the grim irony is that the startup boom is effectively funding an exit from the continent for its top tier of talent.
It really is. And just to be completely clear for you listening, we are not taking a political side here.
No, not at all.
But looking impartially at the Occupy Nigeria and Reject Finance Bill movements through the lens of our economic data, you see a clear correlation.
Right. The movement started over taxes and fuel subsidies, but the discourse expanded into a critique of how global capital operates within their borders. And reading through these Pan-Africanist critiques in our sources, I have to ask a heavy question. Are we essentially seeing a new form of resource extraction? Like, instead of mining minerals to export, is foreign capital mining localized data, talent, and IP just to export it to a Delaware C Corp?
If we connect this to the bigger picture, the structural parallels are impossible to ignore.
Right.
The social media discourse explicitly frames the tech boom through that exact lens of extraction. It's not that people are anti-entrepreneurship.
Right. They want innovation.
They do.
Yeah.
But they are realizing the current VC architecture is inherently extractive. A local community might get a solar mini-grid, but the financial returns and the data fly straight back to limited partners in Europe and North America.
So what does this all mean? We started with this staggering $1.5 billion figure.
Right.
And it is undeniably impressive. But when you unpack the actual mechanisms of that capital, the liquidation preferences, the dual HQs, the currency arbitrage, the structure is fundamentally misaligned with the continent's real needs.
Yeah, it mostly benefits dual HQ founders, foreign LPs, and Western tech platforms.
Exactly. And for you listening, no matter where you live, understanding how this works is so crucial. The mechanics of global capital flows shape the physical realities of our cities and our governments.
They absolutely do.
And if you only read the PR headlines, you are entirely missing who is actually fitting the bill.
Which leaves us with a final thought to mull over.
Yeah.
If the traditional Silicon Valley VC model inherently pulls value out of emerging markets by design, what would a truly localized venture-scale funding model actually look like?
Right.
Could the next major global disruption in tech not be a new app or AI model, but the actual death of the traditional VC structure itself?
It really makes you wonder. Because when winning the digital lottery triggers your state to raise your taxes, you have to ask if it was really a miracle after all.